Welcome to MarketTamer.com. Often in these videos we're looking at stock charts and we're looking at specific technical opportunities, but today we're going to discuss fundamentals, and specifically we'll start with this chart, which is coming in from CalculatedRiskBlog.com. And in these blue bars that you see across from 1960 through to 2010, you see recessions represented by those blue bars across various time frames, and the most recent one is this 2008 period here through to 2009. If we look to the blue line, it's representing unemployment rate, which has rocketed up from 5% to just under 10%, while the year-over-year change in employment has dropped from about 1% all the way to minus 4%. So we'll talk a little bit more about the impact of the fundamentals on the markets in a moment. But before we get there, let's take a look here at percent job losses in post-World War II recessions. And what you can see is a current recession here. There is a very, very steep drop-off here. So what does this represent? Well, if we look to this y-axis here, we're looking at the percent of job losses relative to peak employment month. And on the x-axis here, we're looking at the number of months after peak employment. So all the way through here, this current recession, we're seeing a tremendous downturn, and we're also seeing that potentially start to flatten out. That's what a lot of the contributors on CNBC and Bloomberg discuss as the second derivative, that is slowing rate of change. Not necessarily a positive in and of itself. Obviously, if the trend line remains down, that's still a negative, but the compensation is once that starts to slow, there's a signal that potentially a recovery is impending. We'll talk more again about that relative to the markets in a moment. Before we get there, let's discuss yet another chart here, again coming in from CalculatedRiskBlog.com, and this is a representation of those unemployed for over 26 weeks. So we have, again, with the blue lines, we represent recessions, and that's the blue columns here. The blue line in this chart represents the number unemployed for 27 weeks and over, and the red line represents those as a percent of the civilian labor force. So again, you can see what's happened here. Following the recession, we had a very, very sharp and steep uptick here from just under 1% to over 3%. Again, a negative fundamental in the economy. And finally, we're going to discuss this chart here, which is looking at what is described as a lost employment decade. What does that mean? Well, during this 2000 period, starting right around January 1999 all the way through to 2009 here, what we're seeing is very few jobs essentially created. That's really the definition of this term, a lost employment decade. So again, what we're seeing here are millions of jobs. Current Employment Statistics Survey, how have jobs increased over the past decade? Well, they increased, dipped, increased again, and dipped again. So the net over the decade has not been especially positive whatsoever. In fact, it's looking very, very marginal at best right now. So the question we might ask is, looking at these economic indicators, what is the signal for the markets? And most people would think, well, if the economy recovers, then the markets will recover. But in fact, if we look back over time, for example, back in 1973, we had a V-shaped bottom and the economy recovered 8%, but the markets were down about 48%. So there wasn't a strong correlation. And in fact, what we see is monetary policy dominates much more so in many cases than fundamentals. So we believe that as the economy recovers here, that we could see very threatening news for the markets. And as anticipated, we were expecting the markets to go up through September. That's happening, and after that we'll be very, very concerned, and we'll talk more about that in classes with students. So with that, we look forward to seeing you at MarketTamer.com.